First and foremost, I want to welcome everyone and thank them for joining. My name is John Harris, and I'm Managing Director with Coral Gables Trust Company. Very quickly, a few housekeeping items. The session is being recorded. If you have questions, please send them directly to the panelist chat. Those questions will be answered after the presentation, and we'll have an extensive Q&A session at the end. The presentation should take about 40 minutes, and we'll leave 15 to 20 minutes for Q&A. If you do have additional questions post-event, please email those directly to me. My email is on the cover slide, jharris@cgtrust.com. I do want to thank everybody for joining us this morning, joining us in the next in our Dynamic Wealth Speaker Series events here at Coral Gables Trust. And we have a very timely and important topic today. And we've brought back a fantastic and very esteemed speaker that we've had in the past. We're very pleased to have him again. And I'm going to ask Mason Williams, our Chief Investment Officer, to introduce our speaker. So thank you once again for joining. Mason?
Thank you, John. Thank you, everybody, for joining this morning. Really appreciate your time. Again, Phil, pleasure to have you back. It's been a while, but glad to see you again. So we certainly are in for a real treat today. So Philip Orlando is Federated Hermes Chief Market Equity Strategist and Head of Client Portfolio Management. He's been in the business north of 40 years. Phil's main responsibility at Federated is the formulation of his views on the economy, the financial markets, and the firm's investment positioning. He serves as chairman of both the macroeconomic policy and PRISM asset allocation committees within the Federated firm. And also Phil is a regular contributor to several news outlets such as CNBC's Worldwide Exchange, Squawk Box, Squawk on the Street, Power Lunch, Closing Bell, Nightly Business Report, as well as Fox Business News, Bloomberg, Reuters, the Wall Street Journal, and the New York Times. So with that, Phil, thank you for joining today, and take it away.
Mason, thank you. John, thank you. And I'd like to thank everyone for taking time out of their busy schedules to give my colleague Kip and I an opportunity to share our views with you. As we flip over to the first page, I've lifted this quote out of the Wall Street Journal a couple of months ago. I think this really captures the extraordinarily delicate balancing act that we as voters are trying to grapple with here over the course of the last 2 years, and now culminating in next week's election. On the one hand, President Trump's personality, personal behavior, et cetera, has probably been less good than we'd hoped for, but his successes on policy have been much better. And so how we balance those issues out is going to decide how this election goes. So as we flip over to slide 3, it's my view that this will be the most consequential election in our lifetimes. Now, I don't say that unadvisedly, that we will be selecting the next president of the United States, and that's a significant task in and of itself. But both houses of Congress are in play, the Senate even more specifically, and I'll spend a moment on that. The Supreme Court is very much in play, and the Federal Reserve is on the ballot as well. So I'm going to go into some detail on each of these, but bottom line is that I believe we've got 5 critically important levers of government that we'll be voting on next week. So as we flip over to slide 4, take a look at the president's approval rating on what I think are sort of the 3 critical issues that voters are trying to evaluate. His handling of race relations is probably his weakest area, with an approval rating of only 37%. His handling of the coronavirus crisis, better, at 42%. The only area that he's above the Mendoza line, however, is the handling of the economy, with a 51% approval rating. And frankly, that has been his strong suit over the course of his administration. So as we look at slide 5, the Electoral College map, as it's currently structured for the election, there are a couple of things that jump out. The first is that President Biden, or Vice President Biden, enjoys very strong support in a number of key states: California, Illinois, New York, Massachusetts, New Jersey. And President Trump enjoys very strong support in Texas, the Deep South, the Upper Plains states. Now, neither of those bases are enough to provide victory for either candidate. That for the third election cycle in a row, it will be a handful of key swing states: Florida, Pennsylvania, Ohio, Georgia, Michigan, North Carolina, that are going to decide this election. As you flip over to the next slide, you can see that the Senate, I think, is more important than the presidency in terms of whether or not we will have a legislative check and balance in Washington as it relates to the presidential coattails down-ballot effect that the election will have on the Senate. So let's take a sort of a deep dive into what's going on in the Senate. Currently, the mix is that Republicans are leading Democrats 53-47, a very comfortable 6-seat majority. But Republicans are also defending twice as many seats this cycle, 23 versus 12, which means that the Democrats only need to flip a net of 4 seats, or if they win the presidency, a net of 3 seats, because then Vice President Kamala Harris will be able to break all ties. Now, the bottom half of the slide shows you the 35 races that are being held this cycle. And I think there are really 6 races that we need to focus on that will determine who's going to control the Senate. So I think there is one Democratic seat, Doug Jones in Alabama, that is going to flip over to Republican control. So that will take the Republican lead up to 54-46. I think there are 3 Republican seats that are likely to flip to the left. Susan Collins in Maine, Cory Gardner in Colorado, and Martha McSally in Arizona. That will take the Republican lead down to 51-49, starting to get a little close. We then come down to the final 2 states that I think are in play. The first is North Carolina. Tom Tillis is the Republican incumbent running for election. And 3 or 4 weeks ago, I had this state, this race in the flip column. But something stupid happened a couple of weeks ago. Tillis's opponent, a guy by the name of Cal Cunningham, the Democrat, has gotten himself involved in some sort of a sexting scandal with a woman who apparently isn't his wife. Democrats in North Carolina tend to be pretty conservative, and that has put North Carolina back in play. The other state is Michigan. Gary Peters is the incumbent, a Democrat. This seat was also safely Democrat 3 or 4 weeks ago. But Peters' opponent, John James, a Republican, has been coming on like a freight train the last couple of weeks. Peters has sort of a mediocre background. John James has an amazing background. He was a West Point graduate. He flew Apache helicopters in Iraq during the war. He came back to the United States after his military service, has an MBA from Michigan. He's got a Master's of Science degree from Penn State, and he's been working successfully as a businessman for the last 15 years or so. He's also Black, so he has amazing crossover appeal in the state of Michigan that has a significant African-American population. So that race has now become a toss-up. So I would respectfully suggest that how North Carolina and Michigan go, that could very well decide control of the Senate. So right now, it looks like it's going to be 50-50, a coin flip, depending upon how a couple of these key swing states go. Now, why do I mention all of this? Flip over to slide 7. I think it's very important to understand that the power of the purse resides in Congress on legislative matters. Now, what you've got in front of you are 87 years worth of performance data for the S&P 500. And for the most part, over this 87 years, Republicans and Democrats have traded responsibilities in charge of these key jobs. We've had presidents who were both Democrats and Republicans. We've had the control of the Senate, control of the House by Republicans and Democrats. And by and large, it works. Divided government works. Stock market tends to be up 13 to 14% a year, regardless of who's in these jobs. But Look at those last two bars to the right. The performance of the stock market falls off sharply to only 9% and 5% respectively over those 87 years. And the obvious question is why? Why does the stock market suddenly do so much more poorly? And the answer is embedded in the bottom of that bar. In those two regimes, Democrats over the last 87 years were able to successfully control both houses in Congress, which means that there was no legislative check and balance. And Democratic legislative initiatives over the past 87 years have tended to be less business friendly, less economic friendly, less earnings friendly, and therefore less stock market friendly. So bottom line is that divided government works. You can see it right here in front of you. And what voters are looking at, what they're concerned about, is a potential blue wave that will result in fiscal policy that will be less friendly to the markets and the economy. So as we flip over to slide 8, I'd like to take a look at some detail on what are some of the key issues that investors are concerned about. And we start in the upper left-hand corner. Vice President Biden is proposing to increase the corporate tax rate from 21% to 28%. In my mind, that reintroduces the question of inversion and whether or not that will hurt economic growth. So here's the situation. When President Obama left office in 2016, the federal corporate tax rate was at 35%, and the statutory rate was at 39%. Now that compares with a global corporate average of 22%. We had the highest, single highest corporate tax rate in the world. That resulted in a problem known as inversion. That US companies were offshoring jobs, manufacturing, intellectual property. Some cases, they were even leaving the United States and re-domiciling elsewhere, like going to Ireland, for example, because Ireland only has a 12% tax rate. And that had a deleterious impact on economic growth, corporate earnings growth, and ultimately share prices. Now, President Trump came into office in 2017, looked at the inversion problem and says, I know what we're going to do. We're going to lower the corporate tax rate from 35% all the way down to 21%. Why did he pick 21%? Because it's exactly one tick below the global corporate average of 22%. That solved the inversion problem. Suddenly we saw a flood of manufacturing jobs, intellectual property, repatriated assets coming back into the United States. The rate of unemployment in February of this year, just before we shut the economy down in order to save lives from the pandemic, the rate of unemployment was at 3.5%. It was the lowest rate of unemployment in half a century. And Nancy Lazar, the brilliant chief economist at Cornerstone Macro, wrote a report last month where she said that by her own count, there are 176 different companies that have re-domiciled from overseas back into the United States this year alone in order to take advantage of the fact that we've got the greatest economy in the world now, and we also now have a competitive tax code. So the question in my mind is that if we increase the corporate tax rate from 21% currently back up to 28% federal, and therefore 32% statutory, that's 10 points higher than the global corporate average. Does that begin to reintroduce the inversion problem? And what are the add-on effects to that? Don't know the answer, but it's something that I think we need to keep in mind. Second, individual tax rates. Vice President Biden is proposing to restore the top tax rate just under 40% and effectively double the capital gains rate and the dividend rate to the ordinary tax rate. Number three, Vice President Biden is proposing to uncap the Social Security wages at $138,000. So that means that we would pay an extra 12.2%, half us, half our employer, on wages above $138,000 to infinity. Higher estate taxes. Vice President Biden is proposing to increase the estate tax rate from 40% currently to a graduated rate of 77%, reduce the exemption from $11.5 million to $3.5 million, and eliminate the step-up basis on estate taxes. Next, Vice President Biden is proposing to double the federal minimum wage to $15 an hour. Now, we've done a lot of work on the federal minimum wage, and I can assure you the federal minimum wage is too low. And the reason it's too low is that Congress stopped indexing it for inflation in 2009. Had we continued to index it for inflation, that number today would be somewhere between $10 and $11 an hour. So the federal minimum wage needs to go higher. I agree with that. But here's the question. What is the pace at which we're going to make these corrective actions? And what is the level to which we're going to bring the federal minimum wage? If we do this immediately, I think we have three economic problems we've got to consider. Number one, if we've just doubled a company's wage base, they will be incentivized to try to recoup some of those higher wage costs by increasing prices for consumers. That's obviously going to increase inflation. Number two, let's say the company is in a very competitive industry. Let's say they're going head to head with Amazon, and they feel that they would lose market share, increasing prices that significantly. So they might absorb some or all of those higher labor costs that will result in lower profit margins, lower corporate earnings, and ultimately lower share prices. And then finally, if a company is faced with a doubling of their labor costs, perhaps they are incentivized to spend more money on technology to increase productivity and therefore be able to reduce their investment in human capital. And that, of course, will have the unintended consequence of increasing the rate of unemployment. Vice President Biden has talked about free healthcare or restoring some sort of a public-private option to the Affordable Care Act. He's talked about free college education, starting with free community college, perhaps free four-year public college, and there's been some discussion of free four-year private college with some threshold of family income. And then finally, he's discussed absolving some or all of $1.6 trillion in student loan debt. While I understand the economic benefit from that, I'm also wondering about the moral hazard associated with that. So for example, what about those of us that have already paid off our student loans? What about those of us that worked a second or a third job during college in order to get through debt free? What are we going to do for those people that have frankly done the right thing? So I think that we've got to address those questions as well. So collectively, everything that we've just talked about will take taxes up by some $3 to $4 trillion, will reduce corporate earnings per share by about 10 to 15%. Due to the increase in inflation, we're looking at a contraction of PE multiples of about 10%. So therefore, we could be looking at perhaps a 20 to 25% decline in stock prices over some period of time. All right, that's enough on the economy. Let's shift gears and talk about SCOTUS, the Supreme Court, on slide 9. And this is obviously has become a super hot topic over the last month or so since the untimely passing of Justice Ginsburg, who was a lioness on the Supreme Court, a consistently liberal voice over the last quarter century. President Trump has nominated, now confirmed, a conservative nominee, Justice Barrett. She will be an excellent justice, but will likely be a reliably conservative vote for the next quarter century. That situation, particularly in light of the Merrick Garland situation 4 years ago, has Democrats up in arms. And there is some question as to whether or not President Biden would introduce term limits on the court, which might affect perhaps Justice Breyer and Justice Thomas, or perhaps increasing the size of the court, going from 9 justices currently, which has been the standard for 150 years, to perhaps 11 or 13 justices. The average American is not happy with that prospect. And so at the debates last Thursday, Vice President Biden said that he would, if elected president, elect a panel to study and advise him on exactly what we should do with that. Flip over to slide 10. Same discussion on the Federal Reserve, which I also think is on the ballot here. Jay Powell, as the chairman of the Federal Reserve on slide 10, has done a very good job. Cut interest rates to effectively zero at 2 emergency meetings in March, and has told us they will keep interest rates at zero through the end of calendar 23. That's a bold prediction, particularly in light of the fact that his term as the chairman of the Federal Reserve expires in January 22. So the next president of the United States will select the next chairman of the Federal Reserve, either reappointing Chair Powell or selecting someone new. So it'll be interesting to see if we can keep interest rates at zero bound for another several years. And then Vice President Biden has also said that should he be elected president, he would widen the Fed's historic mandate for the last 100 years, the Phillips curve trade-off between price stability and full employment, and to add a new racial diversity mandate to the Federal Reserve's purview. So let's shift gears now, flip over to slide 11, and start to look at the 3 major issues that I think voters are interested in. The first major issue is the economy. So you can see that the stock market dropped by 35% from mid-February to mid-March, the sharpest decline from a record high to a bear market in history, as the equity market, as a forward-looking discounting mechanism, priced in the deepest recession in history. The stock market then rallied by 63% over the course of the next 6 months, as investors priced in the end of the recession, which we believe was in May or June, a strong improvement in the labor market, and the strongest third quarter GDP rebound in history. We're going to see that number on Thursday of this week. And we think that that number is going to be up around 32 or 33%, a very, very powerful rebound. As we look at the next page on slide 12, the second issue that I think investors are focused on is the coronavirus itself. And you can see that we are currently involved in our 3rd wave of surging infections, starting in late August as we sent our kids back to college. And importantly, you'll notice a divergence, a continued divergence between the spike in infections, which is the blue line, and a continued decline in mortality, which is the green line. Given the fact that we are getting closer to realizing a vaccine that will be available for emergency limited use, probably by the end of this year, I think we will be able to manage that mortality and begin to arrest the decline and execute a decline in infections. The third issue on slide 13 are the social protests in the horrific aftermath of George Floyd's murder in Minneapolis on Memorial Day. We're all horrified by what we saw, and we all took to the streets in May and June to protest what we saw. Now, things have quieted down over the summer, but what I find very interesting on slide 14 is that as some of the ongoing protests have become more violent, looting, confrontations with police, that kind of thing, approval for the protests on slide 14 has begun to decline over the course of the last several months. So it'll be interesting to see if that growing disapproval of the violent protests has a bearing on the election. So as we flip over to slide 15, let's talk about the debates. The first debate on September 29th, in a word, was a dumpster fire. It was completely out of control. Chris Wallace of Fox News lost control right from the get-go. The 2 candidates were talking over each other. It got absolutely nothing out of it. The second debate on October 7th was materially better. Both candidates were civil. They got their points across. Susan Page of USA Today did a very nice job moderating. The third debate was canceled due to the president's illness. And the fourth debate last Thursday was an excellent debate. Kristen Welker from NBC News ran a terrific debate. I thought both candidates, certainly President Trump, I thought he probably gave the debating performance of his life and had a nice victory and is enjoying a nice bump in the polls over the course of the last week. So as we look at the betting markets on slide 16, we will note that on Labor Day, the two candidates were tied. And then Vice President Biden took off as a result of the president contracting COVID, his atrocious debate performance in September, and the manner in which he handled the untimely passing of Justice Ginsburg. Vice President Biden opened up a 30-point lead as of a couple of weeks ago. He was up at 35 to 65. But as I said, he didn't do particularly well in the debate, and his numbers have been coming in pretty sharply over the course of the last week or so. That from a 30-point lead, 65 to 35, that lead is now inside of 20 points and coming down more sharply. A question I often get asked is, how did Secretary Clinton look in this Real Clear Betting Markets poll exactly 4 years ago? And the answer is that Mrs. Clinton had a lead of 88 to 13 over candidate Trump just before the election, a 75-point lead. And we know how that election turned out. So the point at issue is that this betting market can move very violently, very quickly. So I'm not completely sold on a runaway blue wave here. But as we look at slide 17, certainly the betting markets, again, this is predicted, thought that a blue wave was a more likely outcome. That number moved up into the upper 60s. It's now pulled back into the upper 50s over the course of the last week or so. As Vice President Biden's poll numbers have come down, the chances of a blue wave have receded as well. So let's talk about voter enthusiasm on slide 18. As you can see, enthusiasm for Trump from his supporters significantly higher than Biden. Not quite 2 to 1, but pretty strong. And as we flip over to slide 19 to take a somewhat deeper dive on that question, support for Biden, by and large, is more a vote against Trump than it is a vote for Biden. Yet those people who are supporting Trump by almost a 4 to 1 margin are supporting for Trump rather than against Biden. Now that enthusiasm shift is very important as we get into voter demographics on slide 20. But as we look at the way Republicans and Democrats are reacting to coronavirus, Republicans by and large believe that the coronavirus, the worst has already happened. And so by a 6 to 1 margin, Republicans are planning to vote in person. Democrats, on the other hand, by almost a 2 to 1 margin, believe that the worst of the coronavirus is still to come. So as a result, they are planning to vote by mail by a 2 to 1 margin, which means that of all the mail-in ballots we're likely to receive, 80% of them are going to be coming from Democrats, a 4 to 1 margin. So slide 21, the demographics of the election. For the second consecutive cycle, independents are going to be the largest voting bloc. They will determine this election. 42% independents are much more than Democrats at 27%. Republicans at 28%. But this slide does raise a very interesting question. That when you look at how badly the polls missed the 2016 election, and then you look at where we are in the 2020 election, many of the national polls show Vice President Biden with a huge lead over President Trump. But when you dig into those polls, what you find is that the pollsters are counting Democrats over Republicans by some 10 or 15 percentage points. So the obvious question is, why is that? The answer is, I have no friggin' idea. That when you look at the voter demographics, Democrats and Republicans should be roughly equal in the way they're constructing the polls. I believe that there is a voter oversampling bias error that was embedded in the polls in 2016 that is still in the polls in 2020. Now, the reason I believe that is that there is one company called Trafalgar, which attempted to correct for those polling errors in 2016. So while all of the national polls had Mrs. Clinton winning in a landslide, Trafalgar said that Trump was going to win. What happened? Trump won. Fast forward 4 years. All of the national polls have Vice President Biden winning in a landslide. So the question is, what is Trafalgar forecasting? Trafalgar is forecasting that Trump is going to win again. They have corrected for the oversampling bias error, and they believe that Trump will squeak out a narrow electoral college victory, while Vice President Biden wins a very comfortable popular victory. But remember, we select our presidents on the basis of the electoral college. Now, as investors on slide 22, one of the things that worries us more than anything is this blue wave, because there would be no legislative check and balance. So 84% of us are bearish or very bearish about the prospect of a blue wave. However, I would respectfully suggest that this is not priced into the market. How do I know that? Flip over to slide 23. Slide 23 is the gold standard in forecasting elections over the last century. That if the stock market is collectively positive in August, September, and October, then the incumbent party typically holds on to the White House. If the stock market is negative in those 3 months, then the opposition party typically regains control of the White House. How has this indicator worked? Over the last 9 elections from 1984 to the present, this indicator is run the table, 9 out of 9 positive, 100% accurate. And since this indicator began in 1928, it has correctly predicted election results 20 out of 23 times, 87% accurate. So the obvious question is, how is the stock market doing this cycle? Through last Friday, from July 31st through last Friday, the S&P 500 is up by 6.4%. That would suggest that President Trump is in the catbird seat. Now, the stock market was down 2% yesterday. So that number is now 4.5% instead of 6.5%. So if we lose another 2% every day for the last 4 days, then that could swing this indicator over into President Biden's column. So obviously, we're going to be watching this really closely. But right now, this indicator is saying that Trump is in good shape. And remember, this indicator is pointing in the exact opposite direction of the polls in the betting markets, which are telling us that Biden is going to win this thing in an absolute landslide. They both can't be right. One of those indicators has to be wrong, and we'll find out soon enough. So I think on slide 24, we are looking at the prospect of a contested election. Now, I've got 2 pages of information here. I'm going to hit a couple of highlights to tell you why we believe that. At the top of slide 24, I think it's just simple math. In the 2016 election, we had 33 million mail-in ballots out of 139 million ballots cast. Because of the concerns about the coronavirus, the experts are telling us that we will have more than double the number of mail-in ballots this cycle, something in the neighborhood of 70 or 80 million mail-in ballots out of 150 or 160 total million ballots cast, which means that the number of ballots could be literally half of all ballots cast. And we know, based upon the data we talked about before, that 80% of those mail-in ballots are going to come from Democratic voters because of their concerns about the coronavirus. Now, on election night, it is absolutely my belief that Vice President Biden will be well ahead in the popular vote, given his popularity in California, Illinois, New York, New Jersey, and Massachusetts. But as I study the polls state by state, particularly in the key swing states, it is my belief that President Trump will be ahead in the Electoral College. Then we get to the process of opening up and tabulating 70 or 80 million mail-in ballots. We're not going to know the night of the election who won this election. It's going to take us a month or 6 weeks to go through that many ballots. And remember that 80% of the ballots are cast by Democrats, and 20 to 25% of the ballots are going to be disqualified. Why do we believe that? Because there are a number of mistakes that are already popping up. These are the typical ones. The signatures on the mail-in ballot didn't match the voter ID card. The postmark requirement possibly would not be met. A witness signature is missing. The double envelope system was ignored. All of these are grounds for throwing out the ballot. Now, disproportionately, the bulk of those disqualifications are going to impact young and minority voters. They tend to be first-time voters, so they're going to make mistakes. And those demographics also happen to be more Democratic supporters. So ultimately, I think you've got armies of lawyers on both sides that are watching what I've just described very closely. They're going to be very upset. There are going to be lawsuits and counter lawsuits all across the country that are likely to end up at the Supreme Court, much like we saw in 2000 when the Supreme Court settled that election in December of 2000. But the stock market dropped about 13% between the election and when the Supreme Court eventually resolved the election. So slide 25, this goes through some of the steps that will happen if we have no clear winner. If neither candidate has 270 electoral votes, then this election is going to go to the House of Representatives. But every representative will not have a vote. Every state will get one vote. It's a 50-vote election. California's vote will count as much as Rhode Island's vote. And right now there are 26 state delegations that are Republican, 23 state delegations that are Democrat. And then depending upon how this plays out, if we do not have a president or vice president, we have to go through something known as the presidential line of succession temporarily. Then Nancy Pelosi, for example, the Speaker of the House, is third in line for the presidency. Fourth in line is the President pro tem of the Senate, currently Chuck Grassley. But again, I talked about the fact that the Senate could be 50-50 after the election. We may not have a President pro tem. So therefore, we may have to go to cabinet secretaries in this order: State, Treasury, Defense, and the Attorney General. Ultimately, Inauguration Day is January 20th. Hopefully, all of this will be resolved by then. But because of the confusion and the uncertainty, the stock market could mirror what it did during the 2000 election, which meant that the stocks were down about 12 or 13% over the course of that 3-month period. So my election conclusions then on slide 26. I believe the polls are going to tighten, and I do believe that most of the national polls are wrong in terms of the oversampling bias error. I think ultimately this is going to be a very close election. It's going to be a coin toss, and I think it will be decided in the Electoral College. Looking at the 3 key issues that are driving this election, I think coronavirus infections and deaths continue to diverge, and I think we are looking at the introduction of a vaccine, at least for limited emergency use, by the end of this year. Second, the economy in the spring fell into the deepest recession in history. Second quarter GDP was the worst in history at a negative 31.4%, but the recession ended in May or June. And it is our belief that third quarter GDP, which will be flashed on Thursday of this week, 32.4%, will be the strongest GDP in history. And I think that will have election implications. And finally, the social protests have quieted nationally, but approval for those protests has faded over the last several months. It'll be interesting to see if that has any impact on voting behavior. Final point is the stock market back in early September was sitting at all-time record highs. And we're positive from July 31st to the present, which means that President Trump is in good shape for winning renomination and re-election based upon the historical precedent of this indicator. But the polls and the betting markets are pointing in the complete opposite direction. They're telling us that Vice President Biden and the Democrats are going to run the table here. It's going to be a massive tsunami, a blue wave. Now, both of these indicators can't both be right at the same time. Either the stock market's right or the polls and the betting markets are right. I don't know which one it's going to be, but I think we're going to see increased volatility and the potential for a contested election, which is going to create some market uncertainty for a period of time until the Supreme Court steps in and we get this all sorted out. So with that, John and Mason, let me stop talking, flip the talking stick back to you, and I'd be delighted to answer any questions that you or any of your clients have. Thank you very much for your interest and your attention, and again, for the opportunity for me to allow me to share my thoughts with you. Thank you.
Great, Phil. Thank you so much, man. That was an excellent presentation, incredibly informative, very interesting. And we do have some questions, so let's jump right into it. First one, what is the past rate that mail-in absentee ballots have been invalidated? Does it come close to the 20 to 25% just mentioned?
It does not. That the number might be closer to 5 or 10%. So because you have so many first-time mail-in voters, our sense is that the rate of disqualification is going to be higher.
Yeah.
And so if it was 5 to 10% historically, we're thinking it might be 20 or 25%. You know, maybe 25% is a little generous. So maybe 20% is a better estimate, but I think it will absolutely be higher than we saw last cycle, simply because of the law of large numbers.
Right.
You've got so many people that are voting this time, they've never done it before. And frankly, the rules are confusing.
Right. Okay, that certainly makes sense. All right, let's move on. Another question here. The healthcare problem is that the U.S. spends 18% of GDP on healthcare against a 13% to 14% rate in peer economies such as Japan and the EU. Maybe a single payer is the answer. Any comments?
Yeah, I mean, there's a school of thought that we do spend much more than any other developed economy in the world on healthcare. And there are those who would say that our outcomes are less good, which means that we're not spending the money as wisely as we should. So what's the alternative? That maybe a government system is the way to go. But the question is, okay, if we went to a government system, does that mean that we would suddenly spend less money on healthcare? I don't think so. And when you get into a government-run system as opposed to a private system, the government system tends to be less efficient. So you then have a situation, as we've seen with countries that have government-run healthcare, where the wait list for some surgeries, procedures, et cetera, is very long. And what that then creates is the potential for a black market. That private physicians, private hospitals will then pop up and say, okay, we're still here, but we will not take government health care. We won't take Medicare or Medicaid. You want to work with us, it's a concierge system, you've got to pay for it. So then you create sort of this dual system where the wealthy who can afford health care are paying up for it, and the other 99% are left to their own devices, working with lesser doctors, lesser hospitals, et cetera, that are going to provide government health care. I don't know if that solves the problem. The system we have right now isn't working. And I'm not sure that a full government healthcare takeover would work either. What I'd love to see is a system in which you're protecting three things. Number one, pre-existing conditions. Number two, keeping your kid on your program until they're 26. Number three, making sure the insurance companies can't discriminate against you with annual or lifetime artificial caps. But having the efficiencies of private healthcare creates better care at lesser prices. And so if you could somehow combine those elements and make sure that you've got a social safety net in place for, let's say, the bottom half or the bottom quarter, but folks in the top half ought to be able to pay their own way. And the competition associated with private healthcare ought to give you greater efficiencies and lower costs. So I think embedded within those points that I just made is probably the solution. I'm not sure that I should be the energy czar to come up, or the healthcare czar to come up with the ultimate plan, but I think the elements of a successful plan are there. We just have to put them all together.
Okay, makes sense. Quick question that regarding, would the recording be available? It will be available to everyone that has attended today. So we'll make sure that we provide a link to the recording. Another question, probability of the House flipping now or the next cycle, the House of Representatives?
Yeah, that's the second time I've gotten this question today. People are fascinated with the prospect of Pelosi getting driven out of office. Let me share some stats with you. So the way the House is currently set up, Democrats have a 232 to 199 lead in the House, a comfortable 33-seat majority, which means that the Republicans would need to swing a net of 17 seats in order to regain control. That's a pretty tall order. Not impossible, but a pretty tall order. Now, real clear politics. Now, remember that every member of the House runs for re-election every 2 years. So everyone is up for grabs. But real clear only rates 31 toss-ups. But of those 31 toss-ups, 19 of them are Democrat, which means that if the R's ran the table on those toss-ups, they could regain control of the House. Not impossible, but statistically improbable. So could it happen? Yeah, it could happen, but you would need to have sort of a red wave. I think the most likely outcome, if you're rooting for the Republicans, would be for Trump to lose the popular vote, but win the Electoral College narrowly based upon some of the key swing states. The Republicans hold on to a narrow majority in the Senate, and maybe they trim the Democrats' lead in the House by a couple of seats. That to me would be sort of a best case scenario for the Republicans. Democrat best case scenario is they run the table. Yeah. Blue tsunami, they've got all levers of government. They can execute their legislative mandate.
Okay. All right. Another question. Are the top 5 or 6 tech stocks really making the market look better than it is?
Absolutely. So you look at that 63% rally we talked about from March 23rd to September 2nd. The bulk of that rally came from consumer discretion. Large cap growth. The sector that drove the bulk of the large cap growth was technology. The bulk of the technology names that drove the technology rally were essentially the FANGs: Facebook, Apple, Amazon, Netflix, Google, Microsoft, et cetera. So one of the things that we did, Federated Hermes as a firm, last mid-August, so 2 months ago, a little more than 2 months ago, is we started to trim and took some profits. We took domestic large cap growth back to neutral and locked in some of those technology profits and reallocated some money to 3 categories that had lagged badly, that we thought would start to play catch up once investors realized that the economy is out of recession and third quarter GDP was going to be pretty strong. And those categories were domestic large cap value, domestic small cap, and international. And we've started to see some compression of the gap. But those 3 categories have lagged the growth stocks by huge amounts just since last March. So we think there's a lot of catch up that'll take, probably 12 or 18 months to play out. So we think that's a good place to be overweight right now. because the technology stocks that did rally, I mean, a lot of them are trading at, 50, 60 times earnings, where a lot of these more economically sensitive stocks I talked about are trading at, 10 or 15 times earnings. So the valuation imbalance is pretty significant. And we think that there is some catch up that needs to play out over the next year or two.
Okay. Have two questions from the same person. One is, if there is the blue tsunami, can people actually expect the top capital gains rate to go from 20%, which may have gone down to 15, all the way to 40% on long-term capital gains? Is that a real possibility with a blue tsunami?
It's absolutely a real possibility. I would say if there's a blue wave, we can write that in stone. And so one of the things that we need to prepare for as investors is that if that happens, understand the stock market is up 70%, 70% under President Trump in his 4 years. So if you knew with certainty that the capital gains tax rate was going to go up from 20% this year to 40% next year, and you're sitting on 70% of embedded profits in your taxable accounts, why wouldn't you think about locking in some or all of those profits now, like November or December, as opposed to waiting for next year after the tax law changes? So I absolutely think that we are going to see some tax gain harvesting in taxable accounts and a locking in of profits at a lower rate, in November and December, if in fact we get a blue wave. So I think stocks could be down 10% if that happens. I talked about stocks being down, 13% if we get this contested election. So, one of the reasons that we took some chips off the table back in the middle of August is that we anticipated that these two things are possible outcomes. And it's important to, sort of play a little defense and prepare yourself for the prospect that the next couple of months could be a little choppy.
Yep. Okay. And then the follow on, again, with the blue tsunami, I guess you've got the unified credit currently at close to 11.6 million. It prospectively, I guess some numbers are as low as 3.5 being reduced with the blue tsunami. And what can people do at this point to address that, or what can they do?
So you're referring to the estate tax.
Yes. Yeah. Right. I'm sure that's what
the thing. The thing that people could do to protect themselves against that is to die now, I guess. That way, they'd be locking in their profits at a 40% tax with $11.5 million exemption and no step-up basis. I don't think there's anything you can do other than sit down with your tax attorney and your accountant and your financial planner,
and review your documents,
and maybe set up, maybe put some money in the grandkids' names now,
gifting,
pre-fund colleges, that kind of thing.
Right.
So that's really something more for your accountant and your lawyer and your financial planner to sit down and put some strategies together, try to get some money out of your name and into some trust that will be sheltered. Yeah.
Okay. And then there was a question about the information that was provided on the slides. How was that derived? I mean, was it reviewed? I know you have a compliance department at Federated. I guess they were just trying to validate the data. Any comments there?
Was there a particular data point that was a question?
No, it was just a general question about the data.
Sure.
If that individual would like to have, be more specific in the question, please put it in the chat.
Sure. So every slide is sourced, and the data sourcing is in the lower left-hand corner of the slide. And certainly our compliance people are absolute sticklers. We refer to our compliance department as the business prevention division because they make sure they go out of their way to fact check every data point. So if it showed up in my deck, you can take it to the bank that the compliance people have done somersaults to make sure that the information's correct.
Yeah. Absolutely. Being in the same industry, quite certain of that. I think Mason had a comment. Mason?
Yeah, just Phil, thanks. Maybe a two-part question. One is on the bond market, one's on the equity market in general. I'll start with the equity side. As we know, the market's rallied hard off of March 23rd, got all those losses back in a short order. Now we find ourselves here with a market that, again, as the previous guest alluded to, that there's been a handful of stocks that carried us the way. Elections aside and results aside, what's, I guess, going to take us to that next leg higher? Are we going to need that other participation from a lot of the parts of the market that have just still not kicked in to get us to new highs down the road? Because we're kind of sitting here reaping the rewards of holding steady, right, through the last 6-7 months. Now, what do we do? And what can we expect? And then part two is the bond market, just so I can get that out.
Stay with question one, and we'll come back to the bond market. Okay. So I've talked about the fact that the next couple of months could be choppy, for a number of reasons. We could get a blue wave and tax gain selling. We could have uncertainty and a repeat of 2000. And so I've cautioned you to try to husband your resources and sort of get through this period over the next couple of months. But as I look across the valley, past January 20th of next year, we're in really good shape. That come January 20th, good or bad, right or wrong, we're going to know who's running our government, right? We're going to know who the president is. We're going to know who's running Congress. We're going to get stimulus. That we're going to get a $2 trillion infrastructure program. We're going to get a $2 or $3 trillion fiscal stimulus phase 4. And that's going to give us some additional juice next year. We know that interest rates are going to stay at 0. So that's good. We know we're making great progress in the vaccine. So that's good. We know with absolute certainty that first, second, third quarter of next year, the year-on-year comparisons to this year are going to be extraordinarily easy. So that's all good. So what we're actually telling our clients to do is that if the market, comes back over the next couple of months and we settle in at about that 200-day moving average, which is roughly the 3,100 level, that's a buyable bottom. We think the market could rally up to 3,800 over the course of next year. Wow. So the message here is be careful now and be prepared to pounce like a tiger on an opportunity to get an oversold market down around 3,100. And then if I'm right on 3,800, that's, 20-25% move over the course of next year. That's not bad.
Right.
So I think we're setting up in pretty good shape. We just have to be a little careful here because of all the uncertainty that, that we may see over the next couple of months.
Okay.
Does that make sense?
It does. It does. And with that said, so bond market now, with the bond, it's hard to pay a lot of bills with the 10-year Treasury today where it's at 0.77. And we had a rate environment that pretty much stayed flat all summer long, but yet has started to get a little bit more noisy in the trend, right? So we got the 10-year Treasury. I think we had 0.81, give or take, recently, off of lows of 0.5, 0.55, somewhere in that arena. So that's a 30 basis point move, give or take, which is, again, we're looking at absolute rates that are still very low, but that is a big move in bond market talk. The bond market may not agree with the rosy outlook like that on the equity side. So are these levels still saying, hey, hold on, we got some stuff to work through here yet? And I'm not so sure because the bond market is usually right. So what's your take on what the bond market's saying?
So bond investors always tell us the bond market's right because bond investors are so much smarter than equity investors. Equity investors, we're just a bunch of dopes. So that's the way it is. So the bond market and the stock market right now are actually going in different directions.
Right.
As you pointed out, yields are rallying. We're like up at 80, 85 basis points because the bond market is telling us that we're coming out of this recession and economic growth is going to accelerate over the next year or two. All right. That's right. I don't disagree with that. And stocks have been a little choppy here. They're below where we were on September 2nd. Because the market is pricing in some nervousness, some concern about the election and all of that. I agree with that as well. But if we get into a contested election, our bond guys tell us that we are likely to see the bond market flip around and see a massive flight to safety rally that would take yields down to maybe go down to 50 basis points. If it's really ugly, go down and retest where we were at like 30 or 35 basis points. That's a near-term phenomenon. Longer term, as the economy starts to kick back into gear and we're looking at positive growth, bond yields should go higher. But you raised a very interesting question that you really didn't ask. I'm going to address it anyway, which is at 80 or 85 basis points now, maybe treasury yields are at 1%, 1.5% over the course of the next year. We're not going to be able to retire on that. How do retirees who need yield manage in a very low interest rate environment? And we've got a product that we put together at Federated. I don't know if Kip has shown it to you, but it's called the Strategic Value Fund. And Dan Paris and his team, what they've done is they've scoured the world for the highest quality blue chip companies that are paying well above average dividend yields. And right now, the gross yield on that fund is around 5%, which is pretty good. You know, owning high quality companies like AT&T and Verizon and Philip Morris and ExxonMobil, and really good blue chip companies that have a history of continuing to increase their dividends every year. So what I do in my portfolio, I don't have any bonds because I don't like getting 50 basis points or 80 basis points on investment. But I've got a pretty significant investment in the Strategic Value Fund, both domestic and international. And that to me is my bond surrogate. I use that as my yield component. And then I get my juice from other areas, you know, growth stocks, technology stocks, that kind of thing. So I sort of have this barbell approach. So I get my yield from stocks, from dividends of stocks. And that's how I'm able to bypass the deficit that the bond market is giving us in terms of, you know, substandard yields.
Thanks, Phil. Appreciate that.
Sure.
All right. I think that was it on questions. So Phil, I want to, well, you know, I'm going to read a few of the comments because we've got some really great ones. So excellent presentation, opening, great stuff. Thank you so much. That was wonderful. Can you please bring Phil back after the elections? So,
let's see how wrong I was, right?
Yeah, right. Well, so Phil, on behalf of Mason, myself, and everybody at Coral Gables Trust, as well as all the attendees, I just really want to thank you so much for joining us today. And to those that did attend, thank you. Really appreciate you being here. Look forward to having you at the next Dynamic Wealth Speaker Series event. If you like additional information, anyone on Coral Gables Trust, then please contact us. Our information's here on this last slide. With that, I think we'll wrap it. So thank you so much, everyone. Appreciate it. Thank you, Phil.
Thank you very much again. Take care. Good luck.
Thank you.